Welcome to the London Property Podcast, your go-to source for navigating the complex and ever-changing London real estate market. Our digital marketplace provides informative and educational content from industry leaders through podcasts and videos. We cover various aspects of the real estate experience, including buying and selling, finance, law, tax, construction, design, and more. Join us as we delve into the latest trends and developments in the market and gain valuable insights from our panel of experts.
Hello and welcome to London Property, home of super prime. I am your host Farnaz Fazaipour, and today we're looking into the build-to-rent sector in the United Kingdom, and we are introducing Gerard Nock, who's an investor in the sector, and Polly Simpson, who heads the team at Savills. I'm going to hand you over for the introductions. Gerard, welcome to the show.
Thank you. I am chairman of Apsley House Capital, and we are PRS developers, really, and with our partnership with Gerard Homes, we've got over 3,000 units in our pipeline in Birmingham, 2,000 units in our pipeline in Bristol.
Thank you very much. I'm Polly Simpson, Head of Multifamily Development at Savills. I've been at Savills for 10 years working in build-to-rent, which is just about as long as the sector's really existed in the UK, and I've seen it go from strength to strength over that period of time.
Thank you for both of you. Let's start with you, Gerard. Can you just describe to us the landscape as an investor in this sector?
Over the last 12 months, the landscape has become extremely difficult. Sort of going back to April last year, yields were 4 to 4.5%. They are now 5 to 5.5%. Build costs have gone up by at least 20%. So the margins for profit are much smaller than they were. And on top of that, all the investors have got to pay interest rates far in excess of what they were paying this time last year. So when the market was very strong, the market's changed dramatically. We've had a substantial increase in rents because of the shortage of supply. And the shortage of supply is getting greater as number of new developments coming forward are reducing. Of course, the difficulties in the present market, and also people who were intending to buy their own house can't get the funding now or can't afford the funding. And as a result of that, they're becoming renters. So the rental market from the demand is growing and growing, and the supply, although there are developments in the pipeline, the future supply is getting smaller. It's changed, I think, Polly. I don't know what you think.
I agree. I think that the delivery of build-to-rent has never been quite straightforward. There's always been some kind of barrier or problem, be that lack of understanding from planning or construction cost inflation or various different challenges. COVID and Brexit has created an environment that has been very difficult for build-to-rent to really get going. And despite that, we've managed to deliver 88,000 build-to-rent units across the country in the last 10 years. I think that Gerard's right in that the current inflationary pressures in the market is definitely creating a viability gap, which is deterring or slowing down delivery. However, investor sentiment remains very strong for the sector. I think everyone's very long on the returns that can be made. The tenant demand and the underlying fundamentals of why to invest in build-to-rent is there. Deals just harder to get done. And we're having to be very creative in deal structure, but deals are still happening. So £1.3 billion was spent in just Q2 of this year, which was the highest Q2 ever on record since build-to-rent records began. So it's an interesting challenge, but makes our job more important.
And I guess there's a finite amount of how high rents can go because of affordability, so it can't match the related expenses of what's going on behind the scenes.
Yeah, I mean, rental growth is currently tracking wage inflation, which is what it's done for the last 30 years. And so whilst it's high, it's still not out of kilter with what it normally does. And long-term trends hover around 3.5%, maybe slightly below, but that masks massive peaks and huge troughs. So there's a roller coaster of what rental growth can do. But you're absolutely right. It's a factor of affordability. And it is what is, the ability to pay for rent is something that's being prioritised for tenants who are clearly choosing certain things from where they want to live and prioritising the service that build to rent offers. The sector's proven itself to be very popular with tenants.
And do you think this is because people are actually choosing renting as a lifestyle, or is it because buying is unaffordable? What do you think is kind of driving the growth of the sector?
I think it's a combination of both. First of all, the quality of the apartments that you can rent today and the facilities that you get with them, with chill out areas, gyms, and the apartment blocks that have been built today for rent are far in excess, quality-wise and spec-wise, than we've seen ever before. So tenants can rent a property that is the best in class, whereas that wasn't available before because most of the tenants were renting from buy-to-let owners, which was in blocks here and there. So the landlords are professional. Of course, they want to keep the tenants to stay in possession as long as possible, so they really look after the tenants. So the tenants are getting a better deal than they've ever had before. So it's a matter, some students also, people leaving university, they can't even consider to buy. So the opportunity to rent and the flexibility of moving around and moving jobs and moving into a new apartment in a new city makes life very easy for them. And so the whole sector has changed totally in the last 10 years since Polly's been on the scene.
Well, I think what's really interesting about how the sector has evolved is complete market segmentation. So Gerard's right. Some developers and some schemes prioritise this amazing level of service provision and amazing level of amenity accommodation, and with all sort of bells and whistles and alternative spaces encompassed within the building. The other end of the spectrum is that there is just really good, affordable mid-market product which doesn't have any of that. Now, what those operators have in common is this emphasis on the customer journey, the service, the longer-term security, which is really attractive to tenants. But it's been interesting watching the way that the product has evolved to suit a range of different needs and budgets and cater for everybody in the rental sector. I think there are, of course, discretionary reasons for renting. People are able to rent somewhere which is nicer than they could afford to buy in a location which is more central. And it is becoming a longer-term lifestyle choice. And we're living in an increasingly globalized world where people want a bit more flexibility. Their jobs might take them to New York or Australia or in the short term. And do they want to own a house now and make a huge decision? More and more we're seeing no. And that's one end of the spectrum. But of course, there's affordability, and the ability to access mortgage and save for a deposit is the other reason that people are renting. And
also people are really going more towards lifestyle, as you're saying, than they used to, that they want that whole package. So, Gerard, when you're looking for a property to invest in, what are the considerations before going into a transaction?
First of all, you look at viability. So what are the rental values? So build costs are the same wherever you are in the country. Maybe London is a bit higher because of the problems of getting all the construction material on and off site, and it creates delay. So London it is more expensive to build in London than anywhere else. But all the other cities in the country, build costs are the same, and values change enormously. So there are a lot of cities where it's just not viable to build a built-to-rent apartment. So the cities that are strong, London, obviously it is viable because that's where the values and the rents are the highest. Manchester probably got going before any other city in the PRS market outside London. Leeds followed on from that, and now we've got Birmingham has become a city where a lot of PRS investors are looking at and have invested there. Bristol is another good city, but a lot of cities it's just not viable because the rents aren't high enough to get the value, the capital value, to sell to make it viable for the developer. So mainly they are inner cities because initially it's young people that want to, but the age group of these blocks now is varying from sort of 22 to 50.
And I guess, I hate to bring up COVID, but because of COVID, then people really started to realize that, they don't need to be near transport because there's so much flexibility in working from home that you actually want that quality and you want to be able to live somewhere nicer with more space, have your family around you.
Yeah, I think one of the really interesting stats was that my research team informed me that in 2020, everywhere had either stagnant or declining rents apart from Bristol and Glasgow. And the reason that those two cities, looking at a few different indicators, but extrapolating from that, had rental growth was because they benefited from tenants who would like to live in those locations, but actually were working in London or Edinburgh. And actually with working from home, or at least thinking that the long term they'd be working from home longer than they ever could pre-COVID, it encouraged higher paid employees to move out. So Bristol was benefiting from a lot of people relocating from London and commuting in 2 or 3 days a week rather than working in the office 5 days a week, which, commuting for that a longer period of time might put a bit more stress. And it's also encouraged the working from home tendencies and encouraged build to rent design to incorporate co-working space in the lobby areas to facilitate working from home a bit more, and they're proved hugely popular. Zoom rooms, like isolated soundproof boxes for taking your Zoom calls, are more of a feature now than they ever were pre-COVID. But it's been really interesting.
Do you think that the culture in the UK is changing from, the home is my castle kind of thing? Because in Europe, people have always been renters and they've been renters for life, and it hasn't really bothered them. And do you think that is something that's changing culturally, or that would have a transient international audience? So it's naturally happening, or?
Yeah, it's a really interesting question. Do I think that the majority of renters today don't aspire to own their own home? No, I think they all do aspire to do that one day. Are they putting themselves under as much pressure to do that immediately and race through kind of the tick box of what life should be? Probably not. And that is a cultural shift, but it's not a wholesale one that reflects a kind of permanent position of the way that we're thinking about homes and the way that we take pride in living our lives. I don't think we're ever going to move to that German model where you kind of rent for 40 years in the same property and have like a family home which is rented, and that's the norm, or not necessarily the norm, but the majority of people do that. However, I think that we're definitely seeing longer trends. Later household formation, people are living a lot longer before settling down, having fewer children. It's the demographic trends are changing, and that is in some way feeding into renting and buying, and when we decide to do that and when we can afford to do that as well.
Yeah, because you see it in other sectors that, people seem to borrow lifestyles. You don't buy a car, you just take an Uber. Mm-hmm. You don't, go to a hotel, you go to an Airbnb. Now they have even car rentals, you can rent from your neighbour and things like that. And so it's like this sort of, I borrow it when I need it and then I'll move on to something else.
Well, zip cars, you pick them up, you drive them for the day, you drop them off wherever you want to. And I totally see that. And I think that we did a bit of research in looking at what the structure of the UK housing market versus more established rental markets like the US, like Germany. And really think there's probably capacity for like 2 million institutionally owned build-to-rent homes in the UK. And like I said earlier, we've delivered 88,000, so we better get to work, Gerard.
Yes.
We've got a long way to go.
But against that, because of the present depressed residential market, prior to the last 12 months, the lowest number of new planning applications going in for residential development since the Second World War was the first quarter of 2009, after the banking crash. The first quarter of 2023 was 40% below that figure. There is now, the house builders have already got a lot of land. They're reducing what they're building because there's no point building houses that there's no buyers for. They will be building houses for the rental market, I'm sure, because that's got to be a way for them to expand their programme. So they're going to be, so you can see in 2 or 3 years' time, there's going to be a desperate shortage. Interest rates will come back. They won't come back to where they were before. The forecast is that they might level out at about 4% when the inflation comes down to the necessary levels, but I don't think we're forecasting that until 2025 now. It's going to take a bit of time to get the residential market going again, and then suddenly there'll be a massive shortage because all people buying land, getting planning consents, getting ready to build is just not happening. And the only really development programme, I think, or most of the development programme, I don't know what the percentages will be, but you've probably got research on it, is going to be for the build to rent market.
So I think in London this year, build to rent's made up over 40% of starts on site. And that's a lot higher than the long-term trend. I think the last stats I saw was on a national level, it was about 13%, whereas typically every year nationally it's about 8%. And so it's, even though build to rent starts have slowed as a result of all the reasons that Gerard mentioned, it's still making up a much higher proportion than ever before. Which is good in some ways because obviously we do have a chronic housing shortage for every tenure. It doesn't really matter, renting, buying, affordable housing. We need more housing. We don't have a housing target anymore. We scrapped that last year. But it was 300,000. And for the last, I think, 7 years, we've delivered between 216 and 246,000. So we've never actually met the basic target. And that's just cumulative, pent up, created this supply and demand imbalance, which is not going to be met this year for sure. It's actually going to be worse.
You can't see it being met for the next 2 or 3 years.
No.
But until the government tries to do something about it, it's not going to change. But also, regardless of what the government does, it's led by the market. If there is no market to sell apartments or sell houses, then people are not going to build them.
And do you think we're going to see a bit of a rescue in supply from office buildings actually being allowed to be turned into modified to rent rather than build to rent? Or do you see any of that happening on the horizon?
What do you
think? I don't actually.
Yeah.
Because first of all, to convert offices to residential is very expensive. And you never really know what costs are going to be till you get into it. So if you're building a new block, you know exactly what it's going to cost. Maybe offices, because there are a lot of offices that are going to be redundant when all the new rules come in, that they'll be sold very cheaply and it might be viable. But also on where you've got a converted residential apartment from an existing building, it's very difficult to get mortgages for them. So you wouldn't do it for the build to sell market. You could only do it for the rental market. Maybe it's not something that we're looking at all. I don't know if you've got plans for looking at that sector.
But John Lewis is. No?
John Lewis is developing direct development. And I think that from an ESG perspective, it's a fantastic opportunity to capitalise on structure that's already delivered and maybe not being utilised to its full potential. And I definitely see that reuse of materials and things as something that hits a lot of boxes for the ESG conscious and focused investors. Historically, though, the permitted development hasn't made a major feature of build to rent. A lot of investors are maybe slightly cautious of it because it's got for a whole host of reasons.
The unknown element of what you might find when you're developing for start, right?
Yeah, and
also I think all the environmental issues that you can put into a new block quite easily is not so easy to put into a refurbishment.
Yeah, I think the future-proofed element is exactly right, and we're at a regulatory kind of crossroads at the moment with lots of building reg changes, fire safety standards and things, and we currently don't quite know exactly how those will fully manifest themselves in future development, and so I think it can probably be quite hard to retrospectively go back and look at those as well. So I don't see it playing a major part of build to rent, but maybe we should look at it. Maybe it's a good business idea for us, Gerard.
Now, I have had this conversation with you off mics, so you've educated me a little bit about this subject. But looking to the States, you get these sort of single family home build to rents. Mm-hmm. And I remember speaking to you about this before, Gerard, and you said that, from a funding perspective, it makes it a lot easier because you can deliver a house at a time, whereas with the building, you've got to wait for the whole building to finish to get it to market. So are you seeing a birth, or am I late? It already happened. These single family, it's happening.
It's happening. Yeah, I think the market was dominated by one major investor for years, Sigma, and their partnership with the house builder, and who've built up a huge portfolio and probably really gave the confidence to a market that there was demand for that kind of product. It's currently 9% of the entire build to rent market, and I think that research-wise we expect or think it could grow to about 19. It's getting a lot of attention in the UK right now, and we saw a lot of those American investors really come over and target the sector over the course of the last few years. There's a definite demand for that type of property. But it's lower risk and easier from a funding perspective, but that means it's also lower risk from a house builder perspective as well. So at this point in time, for a lot of the reasons that Gerard mainly mentioned, we're seeing a lot of interest in doing it on big master plans, swathes of or parts of phases for build to rent or single family housing being delivered. And so it's enjoying a record-breaking year for capital deployed into the sector. It actually is about, I think, 35% of investment this year, which is the highest it's been, has been in the single family rather than multifamily. And some pretty major transactions happened at the beginning of the year. So we saw the Domus portfolio trade, which was historically called the Thistle portfolio when Goldman Sachs sold that. And that was a pretty big deal for the sector.
And talking about the sector, we've talked a little bit about the birth and the growth, but can we just hear a summary from you? What you think from where we were and where we're going?
I think, and I do a lot of work supporting various different government bodies and political lobbying and around planning, which is my background. And, even though 88,000 units doesn't sound like a great deal to have achieved in 10 years, I think the sector, we can probably be reasonably proud that we started from nothing and have delivered a meaningful contribution to housing over that period of time. Gerard's right in that Manchester, kind of regionally, a lot of international investors really wanted to do something in London first, but yields were pretty tight. Manchester, Birmingham, Leeds, Bristol have all hugely taken off and actually have really substantial supply of build to rent in comparison to other forms of housing, but also in comparison to London, where the population is much greater, but the ratio between build to rent and buy to let is very, very different. I think that the investment thesis for why build to rent, but also why UK build to rent, is really, really strong. And that has continuously attracted new entrants into the market to support its growth. So whilst we saw some of the early players in the sector build billion-pound portfolios and then pause, every year we have about 33% new entrants to the market. So last year there was £4.5 billion worth of capital deployed. There were 49 transactions between 33 investors, and 11 of those were brand new. So about a third of all investors into the UK were completely brand new. Now, a lot of those were UK-based institutions, but a lot of them were also North America. Asia Pac didn't really feature last year, but then already this year we've seen Aware Super come in and buy the Qatari DR stake and Get Living, a huge deal for the sector, particularly because build to rent's just taking off in Australia as well. So that it was a really interesting move and transaction to see. I think, and I keep saying this, but I don't know if I'm going to be proved wrong, despite the major headwinds we've got at a macro and economic level, I think build to rent could still scrape to a record-breaking year this year. We're currently about 2 billion. Last year finished at 4.5.
Do you feel that the government is giving the best support that it can, or what else can they be doing?
It's really difficult, I think, to know exactly what, because government support comes with it a whole wave of political ideology, and the government's made it very clear supporting home ownership is a priority. But at the same time, it can't really abandon the fact that so many people rent in the UK and can't afford home ownership. And with the kind of removal or cease of Help to Buy, and rising mortgage rates and a whole host of other reasons we've already discussed, we're definitely seeing a longer term renter or the fact that the rental sector isn't going anywhere. Now, I think that there's been various different initiatives over the course of the last 10 years to help build to rent. Some of them more success than others. There were some Homes England initiatives with lending into build to rent, but really speaking, we haven't had much support, and that hasn't really hindered growth. I think we probably only really had capacity to deliver 88,000 units in that time anyway. So, it's not ceased yet. I think that planning continues to remain a struggle, and policy is or has been somewhat accommodating around various different nuances for long-term renting, but it's implemented differently in every single part of the country. And so when we look at schemes in Bristol and Manchester and Birmingham, as a team, we know what we can and can't do in those locations, and which to my mind shouldn't necessarily be so. It should be a bit more transparent and a bit easier to navigate through what build to rent means in a specific part of the country.
I was actually going to go on to asking you about planning, just a little light version of the whole planning process.
The planning process is pretty much the same for open market sales. It's the same use class, C3, consent. You can, just like anything that anyone's ever built before, you can rent it or you can sell it. Now, there are some nuances to design, and historically we've delivered more units per core. Potentially floor to ceiling heights have been bigger, but there's also been a huge emphasis on that communal space, which might have offset your private amenity space. But the main issue is that the build to rent investors are long-term holders of building. They want to control their own destiny, and they don't necessarily want a third party managing affordable housing inside their building. They're not against affordable housing, but they want to be able to own and operate and manage it. And also that's got its own social benefits. They want their tenants of affordable housing to have access to the amenity space, which becomes logistically and practically quite a challenge when you've got a third party that's responsible for some units within a building. So there's an alternative tenure of affordable housing called discount market rent if you're in London, affordable private rent if you're outside of London, just to make things confusing, and a mid-market rent, MMR, if you're in Scotland, but they're all basically the same thing. And this should be exactly the same as traditional affordable tenants. It's the same kind of process, but it just means that investors can own those units. And that might be a benefit to mentioning build to rent as you go through planning. And in which case you then end up with a covenant which should be 15 years, and some local authorities like longer.
So just to wrap things up, so the investors in this space have kind of been professionals who've been involved in this. Do you get passive investors? And for a passive investor who thinks, okay, well, the UK is growing in this sector, maybe I should give my money to somebody who knows what they're doing. What does that investment model look like?
I can say the primary way that investors are investing in build to rent is through the development of new products rather than finding operational products, because largely we're supporting housing delivery, and secondly there isn't enough product to go and buy. And so the way that that's working is that investors are working with developers like Gerard to forward fund their delivery of the property, which can be a great solution for Gerard because it releases capital very early on. So paying the land value up front, paying construction costs as expended, and then a profit payment at practical completion. It gives investors the ability to influence design to some extent. We don't let them have too much influence on design, do we, Gerard?
That's right.
I'm just kidding. I'm kidding.
But it's fit out and
specification and regulation, and to some extent, the use of amenity, and it allows them to access product and spend and allocate capital at that point in time. Now, there's a whole host of nature of investors, direct UK pension funds, investment managers with other capital sources sat behind them, and UK-based propcos. We've got listed entities like the Granger and Sigma, the PRS REIT, and that invest into the space, and all of them have got various. That's got quite fragmented. The shareholders in those businesses are really interesting to look at, actually, with the range of global capital from all over the world.
So that brings me to my last question, which is obviously Savills are leading the way in the build-to-rent sector as a professional service. So for our listeners, what are the value adds that Savills brings to an operator, an investor, or, and there is a difference between build-to-rent and PRS operators and so on. So can you just, again, give us a...
Yeah, so I think
light version,
yeah, a quick snappy. From the investment side, we've got about 70% market share, and in all investment into UK build to rent, be that single family, we might actually be slightly higher on single family at the moment after some big deals this year, but about 70% in all multifamily transactions, and that kind of view of what's going on in every single location, and I think it means that when we are bringing forward schemes, they're always viable and deliverable. We also do everything from planning consultancy through to design consultancy to make sure that we're getting the best possible product to maximise demand and investor interest. And that also leads on learning from our property management team, who manage over 4,500 build-to-rent units nationally. And there's a constant feedback loop of information that comes from both that and our market-leading research services.
But also, I think, a very important thing to take into account, these transactions are very complicated transactions. The legal work to get one of these forward funding investments over the line is a minimum of 6 months. And Savills have got the ability, because they understand exactly the mechanics of getting these transactions done. They play a very large part all through the legal transaction. If we left it to the lawyers who don't really understand them, because a lot of lawyers have not done these things before, so you've got a few specialist lawyers that do, but a lot have never done them. They don't really understand them. The number of contracts that you have, which you've got a property contract, a construction contract, a corporate contract, a tax contract, they are very complicated transactions. I think with Heimstaden had something like 8 equity partners at click of chance acting for them in our transaction. It was a nice...
Sounds very expensive, doesn't it?
They apologise for it at the end of the day. But Savills' involvement in that transaction helped to get it over the line. And it's a very important aspect of choosing who you go to, because you can agree a deal that doesn't get done. Of course, it just breaks down in the documentation. So they are a very good team.
Yes.
Thanks, Gerard.
But, the thing is that a lot of times, we as agents understand that, going to the specialist who knows what they're doing is going to be crucial to something succeeding, not succeeding. And sometimes people think, that's too expensive, I'm not going to do it that way. But it's just, when you're talking about a product that is emerging and evolving, it's crucial. And do you normally act for which side?
Developers developers are typically where I'm where we act, but it's probably about a 65-35 split. So advising investors on the acquisition is great from their perspective, and hopefully they'd agree about making investment decisions where and how and how much to pay. But it also makes us really good it ensures we have the knowledge base to accurately advise developers as a result. So if you understand the institutional mindset, then you can act as an institutional seat at the table when it comes to making decisions on design and process and timescales and also mitigating like technical transaction risks, which always crop up. There is always something, and knowing what questions an institution will ask is handy.
If you had to predict what is going to happen in the central London lettings crisis in the next 6 to 12 months, what would you say, Polly?
I live in central London and I rent, so I'm hoping that rents are going to come down by about 25%. But it's definitely not going to happen.
Because I've got a big mortgage.
Yeah. No, I think rental growth is here to stay for a sustained period of time.
And what would you say?
I agree. There's not going to be an enormous amount of development in London in the next few years. The demand is going to expand and rents will have to go up.
So let's hope lots of cash buyers are listening to this and they're going to start replacing the buy-to-let investors that are losing.
Yeah, absolutely.
Well, thank you both very much for your time. Really appreciate it.
Thank you.
And we look forward to coming back to you again with more insight into the subject.
Thanks for tuning in to our latest episode of the London Property Podcast. Head over to our website where you can browse our exclusive network of top experts driving the market. As a member, you'll have direct access to our experts and their networks. Our award-winning content will help you choose the right professionals for your needs and make informed decisions about your investments. Personal recommendations are a powerful tool in connecting with trusted professionals. Let us introduce you to the right people to help you achieve your real estate goals. Contact us now to learn more about becoming a member and gaining access to these valuable resources or joining our directory of experts.